I'm Darren Copeland with Summit Lending, and I've been in the mortgage industry for over 20 years. And today I'm going to break down how to think about affordability the right way, not just how lenders calculate it, but how smart buyers decide it. So let's start with what most people think that determines affordability. They assume it's income. So if someone makes $120,000 a year, they think they can afford a $500,000 house. That's not exactly how it works. Lenders look at four main things, you guys: income, debt, credit, and your down payment. The biggest driver is something called debt to income ratio, or your DTI. That's simply your monthly debt divided by your gross monthly income. So for example, if you make $10,000 a month before taxes, your total monthly debt payments, including your new mortgage, equal $4,500, and your DTI, therefore, would be 45%. So most loan programs allow somewhere between 43% and 50% debt to income ratio depending on your credit and loan type. And that's how the banks calculate it. But here's the truth. Just because you can qualify for a payment doesn't mean you should take that payment. Qualification and comfort are two different things. And here's what I coach buyers differently. Instead of asking, what is the max I can get approved for? Ask this: what monthly payment allows me to still build wealth? Because homeownership is not just about getting the keys, it's about sustainability. So let's break down what makes up your actual house payment: your principal and interest, your property taxes, your homeowner's insurance, and possibly HOAs if you have any. Mortgage insurance, if you're putting less than 20% down, will be also factored in there, and that full number is called your total monthly housing expense. Now here's something most people miss. You also need margin, you guys. You need margin for utilities, maintenance, repairs, and just life. So a good rule of thumb I share is this: keep your total house payment ideally between 25 and 30% of your gross income if you want some breathing room. Can you go higher? Absolutely. But the higher you go, the less flexibility you have. And flexibility equals peace. So let's walk through a real example. Let's say you make $8,000 per month gross. 30% of that is $2,400. That means a housing payment around $2,200 to $2,400 all in keeps you in a strong, stable position. Now, depending on rates, taxes, and insurance in Kansas City, that might translate into a purchase price of around $325,000 or maybe around $375,000. It depends on structure. That's why online calculators are incomplete. They don't know your tax bracket, they don't know your long-term goals or your comfort level, your future plans. They just spit out numbers. So let's talk about down payment next. The more you put down, the more buying power you create. Not because the bank likes you more, because your loan amount shrinks, and that lowers your monthly payment, right? That lowers your debt to income ratios, and that increases your flexibility. But here's the mistakes I see. Some buyers drain their entire savings just to put that 20% down. Then they move in with no emergency fund, and that's super risky, you guys. So sometimes it's actually smarter to put less down. So let's say they put 10% down, keep some reserves, and maintain liquidity. Affordability just isn't math, it's a strategy. Credit scores also matter. Higher credit scores equal better rates, and better rates equal lower payments equal more buying power. So even a 0.5% rate difference can change your purchasing power by even tens of thousands of dollars. And that's why preparation matters. Paying down a credit card and avoiding new car loans, not opening store cards during the underwriting process, small decisions change in big outcomes. Now here's something people don't talk enough about. It's your lifestyle goals. Do you still want to travel? Do you need to invest? Do you want to max out your retirement? Do you want to set yourself up and buy rental property at a later date? So if your mortgage consumes all of your income, you delay those goals. The house becomes a ceiling instead of the foundation. Smart home ownership should support wealth building, not prevent it. And in markets like Kansas City, we still have strong values compared to many coastal cities, and that's a huge opportunity. But opportunity should be approached with discipline, and here's the bottom line. The bank determines what you can qualify for, you determine what you can live with. These are not the same number. When we sit down with clients at Summit Lending, we just don't issue a pre-approval. We run scenarios, and what happens if rates drop later, what happens if you have children, what happens if you want to invest in 2 years. Affordability should be forward thinking. So if you're asking, how much house can I afford? Let's answer it the right way. Not with a quick online calculator, but with a real strategy session. We're going to look at your income, your debt, your credit, your goals, your comfort zone, and then we'll create a buying range that protects your future, not just your approval letter. I'm Darren Copeland with Summit Lending, and if you're in Kansas City or any of the states that we're licensed in, simply reach out. Let's build a plan that allows you to buy confidently, sleep peacefully, and still build wealth, because the goal just isn't to own a home. The goal is to own your future.